Good evening. It's Friday night. You have found the Deerwood Realty live stream. I'm your host, John Schenk. Who am I? I am the managing broker of Deerwood Realty in St. Louis, Missouri. We're a small, very small residential brokerage. We help buyers buy homes and sellers sell theirs. In the evenings, I've been known to stream. What do we talk about on our stream? Well, we talk mostly about real estate. I mean, it's kind of what I know. Talk about pop culture. I don't know. I don't understand pop culture. I find it to be fascinating. And so I usually read something and we talk about it amongst ourselves to see if there's the truth. Wanted to talk about something. I wanted to start the show and I don't know how to do it. Let's take a moment and just talk about a real estate transaction, and I'll let you decide if what I'm saying makes sense or if I'm in the wrong. Because as I've been in the business for as long as I have, I think that I've lost my perfect understanding of what buyers actually like, what they think they're seeing, and what sellers think they're seeing in the marketplace. And let me just start off on the buyer side on this one, and the seller. Well, I guess it'll be both. But let's just say you're, and I don't want to throw anybody on the bus or hurt anyone's feelings or anything like that. But let's say you're going to buy a house. You're the buyer. Okay. And let's say that you put an offer in, the offer gets accepted. After that, there's some back and forth about a number of things. You work real hard to get your mortgage together, and because of some of the things that go wrong, it takes maybe 2 months or more to close on the property. Okay. And let's say it was a frustrating transaction, and let's say that you did your best. Okay. You anytime your realtor told you needed to have a piece of paperwork done, you had it done. Anytime, anybody needed anything from you, you communicated very clearly about what your intentions were and what you were trying to do. You did what you could do. Okay. And you get to the day of closing. And let's say that your closing is scheduled for, say, I don't know, 9 a.m. And all you can think about is how excited you are about this new unit that you've bought, this new house that you've bought. And your realtor hands you the keys and just might say something like, "Hey, it's not funded yet, but as soon as it's funded, I'll send you a text, I'll call you, and then the property is yours. You can go there with your family, you can go with your friends, and it's yours. Congratulations. I know this has been difficult, and I'm happy that in the end you got the property. Again, congratulations." Okay. Now, let's say you're the seller on this transaction. Let's say that you're concerned about how the housing market is starting to look. You put your property up on the market for sale, put it out the first 2 weeks, you get an offer, you don't accept that offer. You get people that talk about how they're going to give you a lot of money, but they don't. There's no offers that arrive. And then maybe 3 to 4 weeks later, you take an offer that's below asking. And you prepare to move out of the house. Now, your house in general is trashed. You decided that you're going to do a bunch of remodeling that you never did. So you couldn't really list your house at the best price, but you put a high price on it anyway because, the market's hot and you need to get your money out. So let's say you go through the same machinations that the buyer goes through. Will the buyer find difficult on the inspection? Will the buyer, have trouble with funding? What will happen? And so, the closing's not for 60 days. You go through this pattern of, yes, they're going to buy the house. No, they're not going to buy the house. Yes, they're going to buy the house. And finally you get to closing. and you haven't moved your stuff. You've literally kept everything in the house up until the day of moving, up until the day of closing. Now you're the buyer again. So this is the first time you've ever bought a house. You bought it on your own. You worked hard, and this is the moment to shine. You set up a time to show your house, your new house, to your family, your friends, the day of closing after it's funded. And you go over there to the new house, and your family's there, and you're like, I got this. I got this. And the seller's junk is everywhere in the unit, in the house. How does that make you feel? I just can't understand why sellers think that they should wait to the last minute to move. You say, well, maybe they have physical ailments, maybe they have financial problems, maybe they have it doesn't really matter. On the day of closing, the buyer should reasonably expect, as soon as the property's funded, to be able to go to their new home without you. Like, it's not your house anymore. And I say this because I find it to be highly disrespectful to everyone. I guarantee you the listing agent is not saying, hey, you should keep your stuff here until the last day. I guarantee they're not saying that, because no one wants this situation. I'm not saying that it's happened to me in the past. I'm not saying that it will happen to me in the future. I'm just saying, put yourself in the shoes of the buyer, put yourself in the shoes of the seller, and you tell me who's in the wrong here. Now, if you want to sit there and say, well, technically they don't own the house, the buyer doesn't own the house, and so it's totally okay. I'm not talking about technical. I don't care about technical, because in this particular case, the house was funded. It's no longer the seller's house. How would you feel? I mean, when you bought your first house, was it a house that you were proud of? Is it a house that you wanted to show your family and friends? You know, or were you embarrassed? Did you not want to show anyone what type of house you bought? I'm just curious, because I can't imagine under many circumstances, other than being totally disrespectful, why it would be okay for the seller to leave their to wait to the absolute last minute to move their things. Now you say, well, the seller's buying another house the same day. They're closing on another house, and so they need to move their house, or the mover doesn't show up. Well, on one of those issues, I understand it. The mover doesn't show up. Sometimes in the summer, it's very hard to get movers like within like 3 weeks. They were booked out. So I get that. I get that. But I just can't understand. Like, if you've got enough money to buy another house, then you need to get out of this one. Put it in storage. Say, well, I don't have the money for storage. You just bought a new house. You just bought a new house. You have money. Well, I don't have any money until it closes. You have enough money for storage for one day. It comes down to, you don't want to move. You don't want to move things twice. I get it. Then don't try to close on the same day that you buy something. Like, I'm going to say this, and maybe it's the wrong thing to say, but when you're in a real estate deal, there's more than just you. Okay. Like let's say you're the buyer. Okay. So it's not just you, it's your lender, it's the title company, it's your buyer's agent, it's vendors you may need to call to get things done when you move in, the day you move in, the moving company, for example. On the seller side, you've got the seller, you've got, title company, you've got listing agent, you've got moving company, you've got occupancy repair work to do, inspection. I mean, you've got all these things to do, all these people involved. It's not about you. It's not 100% about you, especially when you've said you've agreed to sell. It's selfish. It's selfish. Not shellfish, because I don't eat shellfish. It is selfish. That's what I'd like you to think about. Put it in the comment, put it in the chat. Let me know what you think. Is it okay as a buyer to leave your junk in your home the day of closing, or as a seller? Did I do it wrong? If I did, I'm sorry. It's late for me. All right. We got a pretty good show tonight. We're going to go to the Twitter, of course. We're going to talk on Google Trends. There's somebody that did something that's kind of interesting, and we'll see that. We're going to talk about home delistings. We're going to talk about an odd statement by the head of the National Association of Realtors, the lead economist. I don't know what they call it. It's Lawrence Yoon. He said some interesting things that I don't agree with as a real estate agent, but I work every day trying to help people buy homes and sell them, and he works every day trying to crunch the numbers to tell me what the market's really doing. So we have two different jobs. Then we have two articles. I'm not going to lie; they're both from Redfin tonight, and they're different. I'm kind of curious as to I don't know. I thought we'd talk about it. I thought the information was interesting. Let's get to our first story. Shall we? Well, I don't know. Should I set it up first? Should I set up for you? Okay, here we go. People do things for money. And it seems like if people have a lot of money, they want more money. And if you ask that person that wants more money, like, how much money will you be happy with? They'll say nothing. I will always want money. I will always want more money than what I have. There's never a time when I'll be happy. Okay. People like money. Does everybody like money? No. Do the majority of people like money? Yes. It makes you do stupid things. You will sell arms to other people, knowing full well those arms will kill other people. You'll do that for money. You may start an OnlyFans account. Now, obviously, I'm not starting an OnlyFans account, but I mean, you may think that this is the way for you to pursue your hopes, dreams, and passions by putting your body out there on OnlyFans. And we can talk about, certain professions. Are they legit? Are they not legit? You can have that discussion, but just in general, people want money. And even if they have done very well in their lives, it's never going to stop them from wanting more. And I say that in the context of what I bring to you now. A very fascinating. I did that wrong. I tried. A very fascinating story today. Oh, let's do this. Let's play the Twitter. Video now. I'm sure you can see it. There you go. You can see it. Here we go. So what was that? Was that Drew Brees getting struck by lightning? Oh my God, is he okay? That's a normal reaction. Come to find out, Drew Brees fakes lightning strike in promotional stunt for online sportsbook. You did what? How much money did you make as a quarterback in the NFL? And you're going to come out here and do something like this? You're like the top 1% in the world. And you do this? You need money so badly that you're going to fake a lightning strike in a promotional stunt for an online sports book? The hell's wrong with you? What in the world? Do you have no? I mean, how low will you stoop? Seriously. Like, I mean, you need to gain, you need to lend your personal credibility to an online sports book by faking a lightning strike? What is it? I mean, really, like what is your major malfunction? Like, who advised you that this was a good idea? Do you not have any advisors? Says legendary New Orleans quarterback Drew Brees faked being struck by lightning as part of a promotional stunt for betting company PointsBet. A video clip posted to Twitter on Friday shows Brees filming a commercial for PointsBet in Catumbó, Venezuela, a location known for its lightning strikes, when a bolt apparently hits him and knocks the production off kilter. It was viewed more than 1 million times as of midday Friday. Brees confirmed in a subsequent video that he's perfectly fine and buzzing about the sportsbook's latest offer involving its lightning bets, which allow users to make in-game wagers. The stunt comes as online sportsbooks gain popularity and fight for customers. It's certainly a shock, literally and figuratively, says Patrick Reish, director of the sports business program at Washington University in St. Louis. I would say this is probably one of the worst decisions he's made as a public figure. Reish said it's clear that PointsBet tried to do something extraordinary to get the attention of the online sports betting market, which is dominated by DraftKings and FanDuel. But boy, this really feels like it's crossing the line. A representative for Brees did not respond for comment. Brees is an ambassador for PointsBet, which trades on the Australian Stock Exchange and has operations in the United States, Canada, and Ireland. Well, you did it. You did it. Now, I can't tell you what I would like to see happen to Drew Brees. But think about it like this. If Drew Brees has a sudden heart attack, are we supposed to believe that he really had a heart attack, or is he selling some sort of pharmaceutical drug? If Drew Brees is in a terrible car accident, should we find out later that he's wasn't really in a car accident and that he was just promoting the safety of, say, Volvo? Does this cross the line? Yes. Should we be surprised in this day and age? No. I put out a live stream and there's like maybe 4 people watching. Okay? Every night. That's a good night for me. Okay? Now, if I were to resort to this kind of garbage that Drew Brees does, maybe I'd get 10. Maybe I'd get 20. I don't have $1 million. I certainly don't have multi-million dollars like Drew Brees does. I don't want to sell myself for this. Like I just don't. I don't want to sell myself. I would never ever do something like this. It just wouldn't happen. Now, maybe and people say, "John, that's why you're broke." I'm not broke, but I mean, I'm not Drew Brees. I'm trying to figure out who likes outside of Purdue and outside of New Orleans, who likes Drew Brees, like as a person. Like, does he have that good of scores? Like, for instance, we have Kenny Wallace, is from St. Louis. That guy, people love him. I think they call him Q scores or something. I mean, they just love him. Okay. Michael Waltrip was the same way. He could get sponsorship because now this is car racing, I know, but people loved him. It was very odd. I don't mean odd and like I'm not trying to denigrate these people. Kenny Wallace and Michael Waltrip. I'm saying people have they either like you or they don't. And like I put it into my own space. They may not like me in real estate. They may not like my program. I may not have a high Q score. But this Drew Brees, multimillionaire, does this to try and get some attention to this sports book. It's got to hurt the Q score, right? It does with me. I don't care about anybody else. Look, on one hand, it's like, do I care what the guy does? No. If you want to shill for you shill for whatever you want to. I don't care. I don't care. I'm just pointing out how ridiculous it is. The need for you to get more money. It's so gross. It's so gross. It's off-putting. To me. One person. Just ugh. So anyway, not a fan. If I did have anything related to Drew Brees, I mean, did he win a Super Bowl? Did Drew Brees win a Super Bowl? He may have. I don't know. I mean, the Saints were good for a while. I don't know. It irritates me. Let me see. I'm curious. Super Bowl MVP. Okay. He won a Super Bowl. Good enough for me. A Super Bowl winning quarterback. Oh, let's do this. I mean, I'm here. As of 2022, Drew Brees is estimated to be worth 160 million. The quarterback has made close to 250 million from games over the course of his 20 years as an NFL player. 160 million, and this guy is shilling for an online sports book. Wow. Moving on, Deerwood Realty. You may have heard of them. They're a great real estate brokerage. If you're in St. Louis or the surrounding areas, you should probably call John Shink. He's a really good real estate agent. He will help you find a home. He will help you sell your home, and he will talk about himself in the third person if he's on a live stream talking to you right now. What are the rates doing today? They've been going down. Well, they've gone back up. You say, well, they do that every day, John. Yeah, they do. It's kind of like the magnitude of the move, though. That's kind of, I mean, like, where are we going? Like, how fast are we going from one to the other? We've been kind of around the 6.3 to 6.5 range. That's 20 basis points. I get it. But, I think it's the Overton window. I don't know for sure, but I think it's the Overton window that says You take something so extreme, a point so extreme, that when you move back from that, it's not so bad. With mortgage rates 7.2, 7.3%, that was bad. Now it looks like 6.3 isn't 3.4 isn't so bad. But if you would have told me a year ago when the rates were like 2.7, 2.8, well, man, now on a 30-year fixed, you're talking about a serious amount of space. I'd like the rates to be around 5.5%, to be honest with you. I think that's a fair number. Why? I don't know. I'm just always kind of used to that number. I don't pray, like as a real estate agent, I don't pray for the market we just got out of. It's very hard on one's psyche to go to work every day knowing that you're going to write an offer. Your client's going to say, hey, how much am I going to have to spend for this house? And you tell them $20,000 over asking, and the house gets sold for $60,000 over asking. Okay? Because it ruined your whole weekend. You don't want to be told that you're one of 40 offers for a house. Like, that's not good. That's not a good weekend. You don't want to be showing houses all weekend and then at the end of the day have like 4 offers that you write and not one of them gets accepted in the middle of like July. It's not fun. It's not fun. So I don't want to go. Plus, I mean, as we were seeing in the marketplace, I think very clearly low interest rates were just raising the price of homes like significantly. Some people say as much as like 34 to 35% of inflation is based solely on housing, both rents and mortgage payments. It's just not something that you want to do. So yeah, I don't want the rates to be that low. You say, well, John, it helps affordability. No, it doesn't, because the prices, the homes go up higher. So like, let's just say at 5%, okay, let's say you can afford a $400,000 home, okay? And at 2%, you can afford an $800,000 home. Well, all of a sudden that $500,000 home that you could afford at 5.5%, all of a sudden turns into like a $700,000 home at 2%. And then when interest rates rise, it goes back to $500,000 home, and you're left with like a negative equity situation, it seems. I mean, I put it out there. Am I wrong? You can correct me. Put it in the chat. Put it in the comments. Let's go to Twitter. Rick Palacios Jr. starts us off today. It says, urban to suburban migration wave that helped boost single-family rental demand now normalizing. Now, I'm trying to check this chart a little bit more, okay? Because I don't know what this means. It says, of your new single-family tenants, which percentage came from suburbs versus urban locations? Okay, so Q3 of 2020, 41% moving from suburban locations and 59% moving from urban locations. And then Q3 2021, 55% moving from suburban locations, 45% moving from urban locations. Okay. And then finally, 67%, okay, moving from suburban locations and 32% moving from urban locations. So you get this outsized move of suburban to urban. Like, did I do that right? Urban to suburban migration wave now normalizing. Yeah, so it's the exact opposite. Well, that was interesting. You let me know. Now, we're going to do a lot of Canada real estate today. I'm not in Canada. They have a similar housing market that, I mean, it got overheated. I wouldn't say they're a bellwether for the United States. They're their own market. But they notice what we're doing down south of them, of the border. They know. So here we go. No down payment, no problem. You can now lever yourself up to 95% loan to value with shared equity programs on uninsured mortgages. Imagine having the audacity to buy a $2.5 million house without being able to scrape together a 20% down payment, because they'll co-invest up to $250,000 to help you reach a 20% down payment and become a homeowner sooner. In the United States, we can go as high as 3.6%. So 96.4, I believe, on an FHA mortgage. 3%, 3.5 or 3.6% down. Look, you guys that are in the mortgage business, you know more than I do. I'm just saying, in the United States, that wouldn't be unusual. I don't see many people put down 20%. Even if they have the money, I don't see them putting down the 20%. So this isn't new. Isn't new for me. What about you? You in Canada? Are you in Australia? Where are you? What's your market? What does it look like? Let me know in the comment section. Let me know in the chat. I wanted to go over this. This is a tweet thread from another person about the Blackstone's $69 billion real estate fund hitting its redemption limit. We talked about this last night. I want to go over it again. I will just ask you the question. Is this a good thing? Is this a good thing? It doesn't seem like it's a good thing. Okay. Genevieve Roch-Decter writes, Blackstone's $69 billion real estate fund announced today that it's limiting redemptions. This is a scary sign for the real estate market. Let's dive in. Blackstone Real Estate Investment Trust is a real estate investment trust that invests in apartments, industrial, retail, and hotels. It's one of the largest real estate funds in the world, even though it only started in 2016. The fund is only sold to wealthy investors through select financial advisors and isn't available to the general public. Their website says that the 3-year annualized returns are 15.5% with a 4.4% distribution rate. Now, this is a real estate income trust, so it's a REIT, so they have to pay out their profits. I believe they have to pay out 99% of their profits to be classified as a REIT. So what's going on with the fund now? This week, Blackstone announced the fund had hit its quarterly withdrawal limit. Too many investors are trying to pull their money out at once. Blackstone is able to limit withdrawals to avoid having to liquidate real estate assets suddenly. The limits are 2% of net asset value or 5% quarterly. The quarterly limit has now been exceeded, so Blackstone can now limit how much money investors are able to pull out. Now look, 2% of net asset value monthly or 5% quarterly. They've already reached those numbers. Blackstone shares are down about 7% on this news. Coincidentally, Blackstone Real Estate Investment Trust accounts for 7%, about 7% of Blackstone's assets under management. So what is the market worried about? Redemptions aren't the problem. Blackstone can limit those to avoid a run on the bank scenario, but the redemption limit being hit could be a sign that the fund's performance is in trouble now. This is something that I cannot know. I cannot know how the fund is doing for certain unless they're being tipped off. Unless people have a very good idea, like their financial planners and their advisors are saying, get out of real estate now. It says investors are nervous that others are pulling their money out because the fund won't do well going further. But could the fund be in serious trouble? The cost to borrow has obviously risen this year, so the fund won't be able to aggressively purchase apartments and industrial buildings like it has over the past 5 years. A majority of the fund is in apartments. The housing market is slowing down, and we've known that for several months. Here's how the fund is invested. And so rental housing is 55%. Just as a disclaimer, I did have an offer this summer from a BlackRock affiliated company that wanted to buy my seller's home for a pretty decent price and rent it out. There's one other factor to consider here. Blackstone doesn't just make money from the performance of the fund. They also make a management fee of 1.25% per year paid monthly. Even if the fund returns zero, Blackstone gets about $862 million a year for running the fund. Now, look, you can hire somebody pretty good in real estate for probably a couple million a year. These people are swimming in cash. And you say, well, they could go under. Well, yes, because of their bad decisions. Every redemption lowers the fee that Blackstone collects for managing the fund. They also collect 12.5% of the returns with a 5% hurdle. Blackstone stock is down because both the management and the performance fees are expected to be lower. Now, if you can collect 12.5% of the returns with a 5% hurdle, I don't really understand that, because I had always understood REITs to be, I thought it was 99%, but maybe it's 95%. I don't know. Blackstone's redemption limit being hit is a definitive sign that the real estate market is slowing. And the outlook for real estate investing is not good. I'll keep the following story and keep you updated on what's happening. It's not good. I say that it's not good. Just between you and I, okay? So you see like headlines from Twitter, some other companies saying that they want their people back to work in offices. But even now, I just don't see like the need for so much office space that we have in the United States now. I mean, it made sense when you didn't have the ability to work on your computer anywhere in the world. But now, I mean, especially now, I mean, what, maybe 50% of your workforce, like office workforce, probably doesn't have to be in the office. I'm not proud of that, okay? But I can't imagine the devastation that must be going on with office buildings throughout the United States. I mean, seriously. Now, maybe they got some Corona funds and stuff like that, but people have got to be hemorrhaging significant cash in the office space arena. I wouldn't worry so much about apartments. I really wouldn't. Unless the numbers we're being shown are not accurate. I mean, if like just intuitively, if you're raising rents on people, then that means there's got to be some sort of demand, because I can't imagine rates just rising on their own. Like mortgage rental rates or apartment rental rates aren't rising on their own. They're rising because the owners of those properties or the managers feel that they can get away with it. Maybe I'm wrong. I know. Why I did this twice, I have no idea, but we're going to move on. Now, this was an interesting, I wanted to go over this. I've done 2 podcasts that I can think of on quote unquote racist appraisals. Now, understand, let me try to explain my position on appraisals. I think they're crazy. I'll bring up 2 issues for you. One, their accuracy. Okay. I let's just say I have a house, okay? And I have 3 people make offers on the house. No escalation clauses, and all 3 of those offers, I don't know any of the agents, I've not told them any numbers to put down. Every single offer is within $1,000 of each other, okay? And then so like I said, arm's length transaction. I know nothing about these people that are offering to buy this home. The appraiser comes in and estimates that it's worth $10,000 less than what these 3 people offered. Is that an accurate appraisal? Not to me. Not to me. The whole point of an accurate appraisal is how much money is this property worth today at an arm's length transaction? Unduly influenced as well. I mean, like, let's assume that the seller is in good financial condition and isn't forced to sell. There's issue number 1. Now, issue number 2 is, who do appraisers work for? Watch. When you go get a mortgage, you pay for an appraiser. It's a fee, probably in St. Louis between about $400 to $600. Okay. They go out and they give their report to the bank. But you paid for the appraiser. Isn't that a conflict of interest? Who's the appraiser working for? The bank or you? Shouldn't your appraiser work for you, not the bank? To get a mortgage, a collateralized mortgage or secured mortgage in the United States, so that they can sell it 17 times, you need either an appraisal or, sometimes on FHA they'll waive it because the house sold recently or they feel like they have a good they call it an appraisal waiver. I think that's wrong. I think that if you're paying for an appraiser, the appraiser should work for you, not the bank. If the bank wants to appraise the property, then the bank should pay for the appraiser. Then I have no problem with it. You say, well, John, if that happens, the appraisers are never going to give you the prices that you want for houses. Hey, maybe that's okay. They're not doing it now. Let's go on to this. There's a documentary called Lowball that I'll be watching soon. It explores racial inequality and racial bias in the appraising profession. I wanted friends to know that I'm here for the conversation. I'm listening and I'm doing all I can to extinguish any type of bias. Much love. I want to say that I'm hopeful for deeper dialogue too. One side says appraisers are racist and then appraisers say, no, we're not. It's like ping pong with no room for discussion and progress. Here's a little more that I pushed out on my socials today. Well, I mean, to admit that you're racist as an appraiser would take an awful lot. Okay. Do I think all appraisers and appraisals are racist? No. No, I don't. I think they're so bad anyway that it doesn't really matter about race. Like, they're so not good for the most part. It says, I may write about this eventually. This is a loaded conversation with lots of layers. It's not something we talk about easily in 2 sentences. In the midst of necessary discussions about systemic racism and bias, I'll be real that I think we've seen a polarizing narrative emerge about appraisers that has gone too far. So in the future, I have to have lots of open discussion about that and how bias shows up in real estate. I hope we can interact with some of the studies coming out too. If we ever get to a place where we can no longer critique a narrative, that's dangerous. I'm not interested in arguing with anyone either. My posture will be more about dialogue rather than aggressive defense because that's how I'm built. On that note, this year I'm hoping to sit on panels and lead discussions where possible. I want to be more public about this conversation and help shine a spotlight on some of the deeper issues for the real estate community. The narrative is present and it's a great opportunity for discussion and getting better. Last month, I was able to have such a good open conversation locally, and I want to see more of that. But just to clarify, I'm not looking for rants on my social pages. Discussion is cool, though. To me, just in what he wrote, no offense to him, he's going to throw it at all real estate as racist rather than just appraisers. It's not me, it's all of us. I don't particularly like that. Good luck. Joseph Wang, former senior Fed trader, personal views only, not investment advice. Governor Waller issued a statement today disagreeing with the attempt to impose climate change-related regulation of banks. This is in response to a separate notice today where the Fed began a process to put forth such regulations. Climate change is real, but I disagree with the premise that it poses a serious threat to the safety and soundness of large banks and the financial stability of the United States. Me too. I'm 100% with you. And by the way, climate change is real. It gets hotter and it gets colder. The effect that man does have on the climate is up for debate. But it does get colder and it does get warmer. There's no question. Sometimes it rains more too. Sometimes it's cloudy more. Note that the Fed has a lot of power to shape the real economy through banking sector regulations. For example, it can make it much more costly for banks to offer credit to bad industries and thus choke them. This is being tried elsewhere as well. It says little bombshell in the EP's proposed amendments on Basel IV for banks, several proposals to severely penalize fossil fuels. Exposures to existing fossil fuels is a 150% risk weight. exposures to new fossil fuel at a 1,250% risk weight. This gives the Fed, a non-elected group of people, the power to implement a specific political goal without any oversight or accountability. It's very dangerous precedent. Should be stopped. We should commend Governor Waller for his courage to dissent. Wouldn't be surprised to see Fed Waller get moved on to a different position, go work somewhere else, be politely asked to leave. We have to regulate everything. We have to have power over the people. We can't let these people decide things. Terrible precedent. This should not be allowed in the United States. It's a shame that it is. And, you know, whatever party you believe in, whatever party you think is the right party, just know that they're not working for you. Neither one of them is working for you. They're working for the 1%ers, the Drew Breeses of the world. This one I thought was interesting, and I wanted to talk about it like the way I see it. It says, thanks for your unsolicited career advice. Ma'am, you're right. I need to be more professional on Twitter. I'll never be successful. By the way, I see most of your tweets are about your job not paying enough to afford your cost of living. Have you tried being more formal on Twitter? I take a big risk coming out every night with opinion, my own personal thoughts, and YouTube, and by extension, the podcast. I could lose clients for my beliefs. I don't know why. I don't feel like I've said anything too inflammatory, but I'm sure I have. There are times when I get attacked online, my personal appearance. It hurts. Why am I out there? Why am I putting my face out there just for negative comments and stuff like that? Well, I run a business. I'm the face of the business. You may say, well, that's not a good face for the business. I get that, but it's the only one I have. And so, look, I'm out here doing what I can to let you know about Deerwood Realty and what we bring to the table. Could I do more staged video? Could I do more pre-recorded video? Could I do more highly edited videos? Yes. But even if you wanted that, it's not real. The highly polished, perfect video isn't real, especially not in real estate. And I want you to see, I want you to see the fake for what it is. And that's why I'm out here, so that you can see, this is real. This is me. When I get off the show, this is still who I am, like it or not. CH on Twitter, this guy is just coming at it, or girl. Why isn't this one of the biggest stories out there? U.S. families with children under 18-year-olds and then housing units. Do you see how the family is continually declining, but we're building housing units? That can't be a good sign, especially if you're one of those people that says the demographics are what's going to bring, what's going to keep the house prices high when the economy goes to hell. I mean, even here, really think the blues will start to climb. The 18-year-old kids that left the homes 10 years ago are now 28 to 32 and starting to have kids. Putting things in context, looking at the employed 25 to 34-year-olds, since 1990, they have net gained 700,000 jobs, and this population and employees among them is now in secular decline. It says because more people are single now, it says Farzan, want to perhaps give a little thought to some implications of that statement. Perhaps some thought as to why they are single. It says perhaps families with children is a poor benchmark. What about couples with no kid, unmarried but cohabitating, and why shouldn't single people have a house? Good. but this is total families with a child, regardless married, single, adopted. Second line is married couples with children under 18 years old. It's still going down. Now, look, if the narrative isn't going to work that we're going to have more demand because more people are, there's more households, well, that's not good. Like, we got to at least get on the same talking points. Donna, Bacher, broker, just had a conversation with a popular real estate lawyer. No residential deals closing until February 23. He's gone from 40 deals a month to 0. No deals for lawyers equals no deals for agents. In my humble opinion, ignore the SM media chatter. Fire in Ontario is facing a very frosty winter in 2023. FIRE stands for finance, insurance, and real estate. Now, this is in Canada. Some states we use a lawyer in the United States for a real estate transaction. Some states we don't. Missouri is one of those where we don't typically. Market's not very good right now. Will it get better? Sure. How will it get better? Unknown. Does it have to be smoking hot after the past 2 years? No. I've told you earlier in the show, I'm not interested in having it be the way it was. It was terrible. The sellers had way too big of an advantage, and the buyers were just in a terrible position. I like a more balanced market. Final tweet of the night, Danielle Levy. She's in Ontario, maybe even Hamilton. My friend has been a realtor for 25 years, and he told me that he's never seen the market this bad. You know what? I don't believe that. In Canada, and I don't believe it in the United States. After all that went on the past 2 years, you're going to say that the market's never been this bad? I don't know. When I started, it was pretty bad. I disagree. Okay, 3 articles, and then I'm going to head on out for the night. I don't know how long it'll take me to get through them. I don't think it's going to take too long, but let's go to it here. It says home price growth is cooling fastest in pandemic boom towns like Boise and Austin. Well, that's not a surprise to me. Is it a surprise to you that the places where the booms started now are showing a decline? Home price growth has slowed fastest in pandemic boom towns, including Austin, Phoenix, and Boise. As high mortgage rates and an uncertain economy deter would-be buyers. Austin's median price per square foot was up 1.3 year over year in October. That's down from about 24% year over year in February, when mortgage rates were still hovering under 4%, record lows. And in Phoenix, price per square foot was up 6% from a year ago, down from nearly 29% in February. Those 23 percentage point drops are the biggest among the 99 most populous U.S. metros. From February 2022 to October 22, we compared October to February because in many U.S. metros, that's when the housing market was near its peak in terms of demand and competition. Austin, Phoenix, San Jose, Las Vegas, Boise. It says Austin and Phoenix are both places where the home prices soared during the pandemic era buying frenzy as remote workers flocked to expensive coastal cities to more affordable Sunbelt destinations. Las Vegas, Boise, and Sacramento are also among the top 10 metros where price growth is slowing fastest. All I wanted to say is it shouldn't be a surprise that the places that it shouldn't be a surprise. Places where the prices shot up earlier are now going down. I mean, don't you feel like the world's a different place in 2022 than it was in 2020? This one, mortgage rates continue to slide. We talked about this. Mortgage rates are seeming to go down, although they did go up quite a few basis points today. Mortgage rates continued on a slide this week. The average rate on a 30-year fixed is now 6.49%, a decrease of 0.09 percentage points. The 15-year fixed rate mortgage also moved lower, decreasing 14.14 percentage points to 5.76. It's the third consecutive week that the 30-year rate has moved lower after crossing 7 for the first time in 2 decades. Now, this is a weekly survey, which is why they're a little bit behind. Since touching 7.08% in early November, rates have dropped by more than a half a percentage point, capping an exceptionally fast period of increases. At the start of the year, the average rate was just 3.22%. The run-up in rates has had a chilling effect on the housing market. Pending home sales, signed sales contracts that have not yet closed were down 4.6% in October compared to September. It says, here's Lawrence Yun. This is what I wanted to go over. It says, October was a difficult month for home buyers as they faced 20-year high mortgage rates, said Lawrence Yun, chief economist at NAR, in a press release. The downward trend in sales may not last much longer. However, the upcoming months should see a return of buyers as the mortgage rates appear to have already peaked and have been coming down since mid-November. Well, that's because they haven't raised rates yet. They're not even supposed to talk about raising rates until the 15th, I believe. So it says mortgage rates moved lower once again this week as the market awaits fresh economic data. There is hope that mortgage rates may have peaked, bringing some relief to the potential buyers. In a speech at the Brookings Institution on Wednesday, Jerome Powell gave the strongest indication yet that the central bank may be ready to ease up on interest rate increases as soon as this month. It makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down, knowing there's a lag between the policy implementation and the effect on the economy. In order to combat high inflation, the central bank has hiked the Fed fund rate 6 times so far this year, increasing the rate from 0 in March to its current level of 4%. The last 4 hikes have been 0.75 percentage points each. Still, the Fed chair was clear that moderation doesn't mean the rate increases are over. The timing of what moderation is far less significant than the question of how much further we will need to raise rates to control inflation. It's likely that restoring price stability will require holding policy at a restricted level for some time. It's going to be a slow, painful death, is what he's saying. It won't be quick. Well, home delistings hit record high in November as buyers and sellers retreated. I don't know what a home delisting is, so that's what I'm going to read to you. Pandemic boomtowns, including Sacramento, Austin, and Phoenix, saw the biggest jump in delistings as prohibitively high housing costs damaged buyer demand. A record 2% of U.S. homes for sale were delisted each week on average during the 12 weeks ending November 20th, compared to 1.6% 1 year earlier. The share has come down a touch since then, declining to 1.9% during the 12 weeks ending November 27th, which include the Thanksgiving holiday. Home delistings are on the rise as the housing market slows. Share of active listings that went off market without selling weekly averages of rolling 12-week periods. So it kind of just does this. Isn't that wild? And now it's high. We define delisting as a listing that went from active to off market without being sold. Homes delisted during 12 weeks ended November 27th could have been listed during that period or beforehand. Okay, so what'll happen in St. Louis, at least, you have cumulative days on market, you have days on market. If your cumulative days on market, if you take your property off the market, you have to wait, I believe, 30 days before you can put it back on the market and reset the counter for the cumulative days on market. The theory is the longer that the house is on the market, the less it's worth. That's the way it runs for a real estate agent. It may be different in other parts of the economy, but the longer something's been on the market, the less it's worth. So you want to sell the house quickly within the first 7 days, ideally. If you have a listing that's over 100 days on the market, you've done something wrong. You're not a good agent. How many have I had that have gone more than 100? I don't think any. But if there was one, it was like right in the beginning of my career. True story. The first house I listed was the longest I ever had a listing. And it was for an odd reason that I'll talk about someday down the road, but not tonight. It says, sellers are taking their homes off the market because they're often receiving no offers for the price they want to sell for, and sometimes no offers at all. That's due to a sharp drop in homebuyer demand driven by rising mortgage rates and persistently high home prices. While mortgage rates have dipped slightly, The monthly mortgage payment on the median asking price of home is still 40% higher than it was 1 year ago. Some sellers are having a hard time grasping that we're not in a housing market frenzy anymore. It's tough for them to swallow that they missed the boat on getting a high price. This is 100% true. By the time sellers realize their listing was priced too high, has already been on the market for too long, and is considered stale. I recently had 2 sellers take their homes off the market after 45 plus days. I mean, I've listed houses, and I'm telling you, there's no one going to see them. And I mean, they're not ugly houses. I've had many sellers cancel their listings. Usually sellers who pull their listings off the market in the fall do it with the intention of listing again in the spring. But with the word recession out there, there's not as much optimism about spring being a better market. Now people are talking about trying again in another year or two once the economy improves. That's a very odd statement, because like, how much money do you have that you're able to take your house off the market and not sell it if you've already moved to a different house? And how much money do you think you're going to get in the future? I mean, owing to the fact that you got to pay taxes, utilities, mortgage payments on a house that you're not occupying, and you're going to keep it out there for until the spring or even next year or two. That's pretty wild. And the other thing is so let's say that you're currently living in this house. Where are you going to go buy a house at 40% when the payments are 40% more than they were last year? It says one reason why the most expensive housing markets tend to have the highest share of delistings is that the pool of buyers who can afford pricey homes is relatively small, meaning there's a higher chance a seller will receive low interest in their home. No, I think it's more like a lot of expensive housing markets, a lot of the people in those houses are jerks. They're not good people. They don't have any loyalty. They don't have any sense of anything other than their own bestment in life. The furthest they can get is off of your back. And so you're the one that they're going to step on. So yeah, that's what it is. A lot of the expensive houses, a lot of these people are buying houses in cash. They're not even getting a mortgage. So they don't really care about the mortgage payment. That's not their biggest problem. It's how pretty are the sinks. It's what utilities are, God, not utilities. What appliances are in the home? What's the name of the brand of the appliances? Who designed the house? What part of town is it in? All the things that rich people like. It's got nothing to do with the housing market being relatively small for these people. There, I said it. Maybe that makes me a bad person. I don't know. That's all I got for you today. I believe it's going to go to here. Yeah. Well, I mean, look, it's a Friday night. I've been live streaming. Hopefully you've been watching. I suspect not many of you have been watching because I didn't have anybody in the chat tonight, which makes me sad, but hey, whatever. I don't know what I'm doing this weekend for chat. I don't know what I'm doing for a live stream. I got to work on this kitchen sewer floor problem. I'm probably going to have to show some houses. That's where I'm at. I don't know. I would say I'd be on tomorrow, but I don't know. You'll know before I do. No, I'll know. What I would say is this: don't be surprised if I just jump online, and maybe that's why you should set your notifications or something, because it's not likely that I'm going to be able to set like a set time to stream tomorrow. It's going to be kind of like, when can I stream and when can it be effective? That being said, I'm going to head out. Thank you for watching. Thank you for listening. I will catch you on the next one later.